A very good evening, everyone, and welcome to tonight's webinar. And my name is Richard. I'm the organizer and host for tonight. And thanks for your time spending here with us. Okay, so the first thing that I'll like to seek your help to do, especially if you are here for the first time, is to look for Wealth and Joy in the Telegram app and join our Telegram channel so that we can keep you posted of interesting wealth building opportunities and webinars. Okay, so look for Wealth and Joy in your Telegram app and join our Telegram channel. So with that, please allow me to share with you an interesting quote from a gentleman that we all know, and he is none other than Warren Buffett. Now, he once said that if you don't find a way to make money while you sleep, you will work until you die. Now, I don't know how you feel when you hear this quote, but when I first heard it, wow, it really gave me a wake up call, and really got me started thinking about what I'm doing and whether my money is working for me or I'm working for my money. So that's kind of what inspired me to co-found Wealth and Joy with a friend. Okay, so now essentially, I feel that there are two paths to building our wealth, and that is the driver's path or the passenger's path. Now, I like to call the driver's path DIY, where you need to do it yourself to build your wealth. Okay, so for example, you will need to read books, watch YouTube, take courses to learn how to trade, how to invest, and then you got to click the button and basically do everything yourself. It's like, if you want to eat chicken rice, you got to cook the whole chicken rice yourself. Yeah. So that is DIY. Now, the other way is what I call the DFY way, and this is the passenger's way. So, what it means is that if you want chicken rice, just go and buy chicken rice. Yeah, don't have to wash, don't have to prepare. So someone else have done it for you. So it's almost like you're sitting in the first class seat in the airplane, and it get you from point A to point B while you're relaxing in the plane. All right. I know now we can't fly, but we can still dream about it. Huh? So now between these two paths to wealth, which is better? Which do you prefer, right? So I believe some of us may be doing more of the DIY currently. So, well, we could consider to diversify some to DFY. And if you are doing a lot of DFY, then you can consider to do some DIY. That is basically, to me, there's no better way. Both ways are very viable. Now, so that's what I like to share with you. Now, with that in mind, the question is, where can we find DIY or DFY ways to build our wealth, right? So that is what inspired my friend and I to co-found Wealth and Joy, where we put wealth building education and opportunities under one roof. So if you log into the member area, you will see the same quote that inspired us to create the website. And then you will also see different service providers as well as educators who teach us how to DIY or DFY our wealth. Okay, so don't put all your egg in one basket. Always diversify. All right. So I won't bore you with what's inside. You can log in to take a look. Okay. So the question is, how much is it to become a Wealth and Joy member? Well, the good news is the membership is totally free, and all you need to do is just go to my.wealthandjoy.com, and you can sign up there, and you can instantly check out who are and what are the interesting DIY and DFY ways to build your wealth. Okay, so with that done, again, for those who just joined us, please remember to look for Wealth and Joy in Telegram channel. Join it so that we can keep you posted of more wealth building education and opportunities. Okay, so very importantly now for the disclaimer. Now, you are responsible for your own profits and losses. The speaker's opinions are their own and does not represent Wealth and Joy's opinion. Wealth and Joy, its owners, partners, and sponsors are not responsible nor liable for your losses. Wealth and Joy events are for educational purposes only and should not be construed as advice. And when you're in doubt, please seek professional help. Okay, so with that out of the way, now as I was saying that there is both DIY and DFY way to build your wealth. For tonight, we have a special treat for you for the DFY way, done for you, right? You just sit back, relax in your first class seat, and it will help you to get you to your one of your financial goals quite easily. All right, because someone is doing it for you. Okay, so in this tonight's webinar, I'm sure you will also have questions. Now, not to worry, please feel free to type in your questions to the chat box that you see on your screen. If you're using a desktop browser, it will be on the bottom right. If you're watching this webinar on a mobile device, then you will need to scroll up or down and look for the chat box, okay? So you can please feel free to type in any questions anytime. And at the end of the sharing by our speaker for tonight, we will be picking your questions and asking our speaker. All right. So, and also, as I promised you, there is a special treat that if you choose to open your investment account with StashAway, your first 50K management fee for 6 months will enjoy a 50% discount. Okay, Singaporeans all love discount, right? So stay tuned to the end of the webinar and I'll share with you how you can secure this discount. All right. So with that, I'd like to share with you the topic for tonight. And it is how to grow your wealth with StashAway. And it is my privilege and honor to be able to invite the country manager for Singapore for StashAway, who will help us to understand StashAway better and how it can help all of us to grow our wealth. Okay, so Amanda, are you there? May I hand over the stage to you, please?
Thank you so much, Richard. It was a great introduction, and thank you as well for having StashAway on today to share with your community. So I'm just going to quickly maybe share my screen right now. Okay, so thank you everyone for joining us this evening. So as Richard briefly mentioned, I am the country manager of StashAway. I've been with the company for close to 3 years now. When I first joined, I was actually the group head of client experience. So I was leading our client experience team across 5 countries. And if you're a client of StashAway, you have our app, and you've ever written into us via email, drop us a WhatsApp or give us a call, that is actually handled by my team in Singapore. Or if you're based in other countries, you might be speaking to a team member in one of 5 offices that we're in. So, and before joining StashAway, I started out my career at Citibank, where I was servicing the portfolios of institutional clients. So these are your kind of portfolio managers, fund managers. I then moved on to a multi-family office / wealth management firm where I was doing investment advisory for ultra high net worth clients. And then after that, I joined StashAway, as I mentioned, as the head of client experience. But I also right now am a wealth advisor to our high net worth and ultra high net worth clients. And as country manager, essentially, I am in charge of leading the business development of the business in Singapore. And I'm very, very excited to be sharing a little bit more about StashAway with all of you tonight. So maybe just to quickly introduce today's topic, it actually falls under what we call What About Electives, which is StashAway and Inside Look. So this is part of our StashAway Academy curriculum. And it is split between 3 different types of courses. So typically we have the beginner courses that we usually recommend for people to come first to set a good foundation before going for the intermediate and advanced courses. So StashAway Academy is very similar to the course, the webinars that you are currently attending, the same ones that Wealth & Joy hosts, pretty frequently as well. We do this every single week on a few different topics. So today's topic is one of our electives, as I mentioned, and we also have a lot of those educational curriculum. So the same thing that I am talking to you, sharing a little bit more about tonight will also be available on our app. So it is what we call Academy In app. When you download the mobile app, you can watch all of these seminars, the ones that you saw on the previous screen. So financial planning basics, how to invest it right with ETFs, all of that. You'll be able to watch in bite-sized pieces on our mobile app. It's free to download, free to watch. So, if you can't tune in for one of our live webinars, you can always watch it in the mobile app at your convenience. So maybe just to quickly introduce, how far we've come over the past 5 years and to share a little bit more about the history of StashAway. So we were, initially the idea of starting StashAway came about in the early 2016 period. And it was an idea that was born out of our Chief Executive Officer, Michele. At that point in time, he was the group CEO of Zalora Group. And before joining Zalora, he pretty much spent, half of his life in and around financial services, first at McKinsey, advising, financial institutions and banks and insurance companies, and then moving on to be a private equity investor. So at that point in time, he was, CEO of Zalora, as you know, one of the largest e-commerce companies in the world. And then he wanted to, find a place to actually invest his own money. And when he searched robo-advisor Singapore, he could not find anything. So at some point in time, he decided that this was something that he wanted to do. And he met our two other co-founders, Freddie and Nino, who I'll share a little bit more in a bit. But for now, as you can see, we started out in 2016. The company was incorporated in 2016 in September. And then in November, we received our seed funding round. And then we worked towards getting our license from the MAS. So we were granted our CMS license on the 31st of May, and then actually launched publicly on the 18th of July. And then in 2018, we actually closed the Series A round early in the year. And in May, obtained SRS approval from the Ministry of Finance to actually accept SRS funds for investments. So as you now know, if you're a client of StashAway, you can not just invest your personal bank account funds, but you can also invest your SRS funds with us. And then in June, we started our kind of application for a license in Malaysia. And in November, we launched publicly in Malaysia. Before that, in August, on the back of a lot of client feedback, we actually launched our higher risk portfolios, which if you now see on the app, it's the 3 higher risk portfolios in the general investing option. So we did that in August. A lot of the products that we come up with is on the back of a lot of client feedback and suggestions. So, keep them coming. If you're a client of ours, do write into us. We're super excited all the time to hear all of your feedback and suggestions. Essentially what we do is that we pass this on to the product team and we prioritize them accordingly. So, all I'm trying to say is that, do feel free to just share all of your thoughts with us whenever you want. And we're always listening to all of your feedback on this. And then in November, we launched Pay Now. So you very easily now, if you want to make transfers to us, you can do so very easily via Pay Now. And then in December, we officially launched SRS in Singapore. In 2019, we actually in Malaysia launched the direct debit transfer option. So for those of you that are based in Malaysia, you can transfer via direct debit starting in June. And then in July, we closed our Series B funding round. And in that round, it was led by a company called 8 Roads Ventures, which is the global investment arm of Fidelity International. Fidelity, as you know, is one of the largest fund managers in the world. And then in September, we launched our Singapore dollar and Singapore focused income portfolio. I will dive a little bit deeper into what goes into the income portfolio in a bit. But now, just to share a little bit more on when it was launched. And then in November, we launched StashAway Simple. So to give you an idea also of how StashAway Simple came about, a lot of our high net worth clients at that point in time was giving us feedback that they were not able to find a cash management solution that essentially provided them an interest rate on all of their funds. So for example, if you are using a lot of kind of bank savings accounts, you tend to find that they give you, maybe a special interest rate if you essentially buy insurance from them or have a few credit cards or credit your salary with them. A lot of hoops to jump. And then secondly, also a lot of the times the higher higher interest rates is probably only earned on the first $10,000 or $50,000 that you put in there, and then after that it drops drastically. So with StashAway Simple, essentially you earn the projected rate on StashAway Simple on the full amount that you put in. So this was actually on the back of also a lot of client feedback. And then in June of 2020, we were very honored to be awarded a Tech Pioneer by the World Economic Forum. So this is an award given to companies that are using technology to make a difference in its industry. So we were one of 3 companies in Singapore to be awarded this, and we're the only digital wealth manager, robo-advisor to be awarded a Tech Pioneer in not just in Singapore but in Asia as well. And then on the 27th of July, we raised our Series C funding. And essentially, at this point in time, it made us the most well-capitalized player in Singapore by far, compared to a lot of our peers. And in this round, it was led by a company called Square Peg, which is the largest venture capital fund in Australia. And then our lead investor in the Series B round, if you remember, was 8 Roads. They participated once again in this round. And then also another company called Berda Principal Investments, which is a very large and reputable VC fund as well, invested and participated in the Series C funding round. In September, we made it to the CB Insights 250 Global FinTech list, and then was also awarded a top 10 LinkedIn startup. And then on November, we launched in our 3rd country, which is in the UAE, servicing our clients in the entire MENA region. So we have had, quite an exciting 4 years before that. And then in 2021, just recently, we announced that we manage more than $1.3 billion in assets under management, making us the largest digital wealth manager, not just in Singapore, but in Southeast Asia as well. So as you can see on the screen, I've kind of left a few dots without, putting anything on it. But the whole point of that is to share that we have a very exciting 2021 coming up ahead over the next few months. And we will have a lot of announcements as well. So do keep a lookout for that. We're, always coming up and trying to innovate in terms of investment product development. So this is a very exciting year for us. And we can't wait to share all of that with all of you. So maybe to just take a quick step back to the company as well. So as I mentioned briefly earlier, we were awarded the Capital Market Services license back in 2016, right? And back in 2017 from the Monetary Authority of Singapore. So the CMS license is one of the most stringent licenses to get. It is the same license that BlackRock, Aberdeen Asset Management, some of the largest fund management houses in the world. They have the same CMS license for retail fund management as well. And the CMS license, as compared to other licenses, maybe like a financial advisor license, the requirements for minimum capital, the requirements for minimum team experience, the requirements for audit requirements, so tech audits, internal, external audits, is way more stringent for a CMS license holder as compared to a financial advisor license. So the reason that we decided from the start to kind of take the hard route and go with the CMS license is that we felt it was, very important for us to provide that added reassurance to our clients, not just at the beginning, right? We were the first player to get a CMS license from the MAS. And it was important to us to get this license not just from the beginning, but always, because in itself, we think it is quite a signaling effect to all of our clients that we are perpetually meeting regulations and guidelines of the highest standards, requirements of the highest standards, and also to provide a little bit more assurance for our clients. So one big requirement of a CMS license to protect consumers like you guys is what is called a custodial structure. So this is a requirement of CMS license, and it means essentially that when you invest with us, at no point in time are your funds commingled with ours. So when you invest with us, first of all, your funds go into a separate DBS client trust account, so separate from a separate account from all of our operating funds. And then once you invest with us, any cash is kept at HSBC, and your securities is kept at Citibank. So touch wood, and I get this question a lot. If something happens to StashAway tomorrow, your cash and securities will still be safe, essentially in the underlying custodian banks. So there is, essentially you're not taking on any StashAway specific risk when you invest with us. You're only taking investment risk. And typically, touch wood, in the cases of a bankruptcy, what would happen is that probably either our team or liquidator will be appointed to kind of coordinate the orderly redistribution of your funds and the securities back to our clients. So that's with regards to the license. And then to share a little bit more context on that as well, we have so through our license, we hold a custodial structure through our broker Saxo, who also has the capital market services license. And Saxo essentially is also, when you invest with us in Singapore dollars, they are also the ones that converts your funds to US dollars for us as well. And with the team, we have decades of investment technology and management experience. If you want to go have a look of everyone in the team, you can go have a look on our About Us page. There is quite a detailed explanation on it over there. But maybe for me to just briefly take you guys through our founders, we have 3 co-founders, Michele, Freddie, and Nino. They all serve very different purposes in the company, as you can see, and they have all very, very complementary experiences as well. So as I mentioned earlier, Michele, pretty much spent half of his life in and around financial services, and then the other half kind of building a lot of e-commerce and internet or tech companies in general. Freddie was most recently the global head of derivative strategy at Nomura, and before that he's worked at pretty much all of the banks you can think of on the streets, managing billions of institutional and individual funds. And he has obviously more than 19 years in cross-asset investing across multiple asset classes. And then finally we have Nino, who is our chief technology officer, who is essentially a serial entrepreneur. So he's founded and started many different tech companies, many different types of SaaS companies as well, as you can see on the screen. And he's essentially a computer scientist, if you look at his experience as well. So three co-founders with very, very complementary skills. And then we also have a very experienced board of directors. So we have Raj, and I'm not going to dive too deep into that. You can see on the screen, but he is the managing partner at 8 Roads, which is one of our investors. As you remember, he was the 8 Roads invested in both our Series B and Series C rounds. And then also Francis Rosario, who is the chairman and CEO of Asia Capital and Advisors, a private equity firm. And they were essentially investors since day one with us. And then we also have an independent non-executive director, Ms. Sim Hui Hoon, who is a board member of NTUC Income. And she comes from a wealth of financial institutional experience. As you can see, she was formerly the CEO of Morgan Stanley Asia, and then also previously the regional chief operating officer at Morgan Stanley. So we have a very, very experienced board supporting us as well, and we're very, very lucky to have them. And maybe now that we have all of the details of the company itself, maybe to jump a little bit more and to shift gears a little bit to tell you a little bit more about our investment framework, which is probably what, as clients, as investors looking to invest with StashAway, that's probably what's most important to you. So there are 2 aspects to the investment process. One is asset allocation, and the second part is security selection. So asset allocation is essentially, when you think more broadly of how to allocate your funds into different asset classes, like for example, how much of your funds should you allocate to US tech stocks? How much of your funds should you allocate to European equities? How much of your funds should you allocate to Chinese technology stocks? So when you think more broadly like that, that's asset allocation. When you drill down and you try and find, the individual stocks to invest in, that is essentially security selection. So earlier, Richard mentioned a little bit about, active investing, active fund management. So that's essentially security selection. And when you choose individual stocks to invest in, like Singtel, CapitaLand, Facebook, Google, you're doing security selection. And at the end of the day, more than 80% of your returns, actually comes from asset allocation, which is why at StashAway, that is what we focus on when we build our investment framework for you. And, if you look at it the other way, less than 20% of your returns actually comes from security selection. So even though it is the more popular thing that you hear, right? People talking about investing in Facebook, Google, Tesla, because, it is sometimes the more sexy thing to do, is the more fun thing to do. But in fact, it actually accounts for less than 20% of the returns that you see. So for those for investors that are also looking to, invest actively on their own, maybe to share a little bit more kind of statistics on how difficult is it for kind of a non-professional investor to actually beat the S&P 500. So to beat the markets index or the Straits Times index or any other index benchmarks. And we'll compare this with a professional investor. So someone that does this on a daily basis, actually research companies to invest in on a day-to-day basis. So according to a SPIVA report, and this SPIVA report, SPIVA, you can find it online. According to the SPIVA report, more than 92% of US large cap funds, so active fund managers that choose large cap stocks to invest in, more than 92% of them actually underperform their respective benchmarks over a 15-year period, right? And then sometimes I get, people telling me, okay, man, that's only for US large cap funds. Well, that's not the case. It's not just for US large cap funds. It's actually, in fact, even worse for US mid cap funds. It's more than 94%. And then for small cap funds, so active fund managers that tries to beat the index by choosing small cap stocks that will outperform, more than 95% of them actually underperform their benchmarks over a 15-year period, right? So looking at that, let's just to quickly share a little bit more. Is this just a US problem, or does it actually make sense to maybe focus your security selection in other geographies? Well, the answer is no, not really, right? So as you can see across other continents like Europe and other countries like Brazil, Australia, the majority of active fund managers, so people that do this, do security selection on a daily basis to try and find the winners and the losers in their funds, the majority of them actually underperform their benchmarks. And the only exception here is India, where it's 43%. But to be honest, the reason here is mostly because it is obviously, a less developed market. There tends to be a little bit more information asymmetry. And if you take a step back as well, 43% is still not a very optimistic number because, it's essentially a coin toss whether or not your fund manager in India is going to outperform the benchmarks, right? So should you pick stocks for StashAway? We don't think so. And for us, what we invest in is ETFs or exchange traded funds, and we focus on asset allocation. So what does it mean to focus on asset allocation? This is what I mentioned earlier. Asset allocation is when you think more broadly of what percentage of your funds to invest in the different asset classes that you see on the screen. Security selection is when you go into one of those particular asset classes and only choose one particular security, right? So how do you get exposure to the different asset classes, like equities, bonds, all of that? You can choose exchange traded funds, right? And essentially what an ETF is that it is a fund that replicates a market's index. So I'll give you an example. Let's say we have the S&P 500 index. So it's a very, very popular US market index. Tells you overall, essentially how the US market is doing. And what it represents is it has in the index the 500 largest securities in the US. So if you have an S&P 500 ETF, what it essentially does is that the ETF buys the 500 securities in the exact same proportion as the S&P 500. So theoretically, if the S&P 500 ETF goes up 1%, the S&P 500 ETF should also go up 1%, right? If the underlying index goes up 1% and your ETF goes up 5%, then there is a huge tracking error, meaning it's not tracking the index very well. Okay, so we use exchange traded funds at StashAway. There are a few different reasons, and this is the top three, which is, first of all, it is very diversified in itself. As I mentioned, one ETF in the previous example means 500 securities in the ETF. So in our portfolios, we have 7 to 11 ETFs. So that is very, very diversified portfolio and a very globally diversified portfolio. And secondly, because ETFs tend to simply replicate an index, at least the ones that we invest in, the passive ETFs, they just simply buy the exact same thing in the underlying index in the exact same proportion. It tends to be way more cost efficient than the active fund managers. So like your unit trust. So your unit trust, typically in Singapore, that's very popular. These are fund managers that actually actively thinks about and does research of which stocks to add into the fund, which stocks to remove from the fund. So obviously that tends to have a higher cost involved, simply because there is way more overheads involved in the investment strategy. So ETFs tends to be cost efficient, while for unit trust, the fees on average that you're looking at on average at least kind of a 1.5%, 2.5% entry fee and 1.5% annual management fee. So according to a Cerulli report, this is actually the average unit trust fee structure in Singapore. And if you compare that, and I'll expand a little bit more later, but that is obviously drastically higher than the management fees that we charge, which starts from 0.8% and it goes lower to 0.2% the more you invest with us. Lastly, ETFs are very easy to get in and out. So it's very liquid because it is, in its name, exchange traded. So whenever you want to sell the ETF, you can easily find a buyer on the other side, right? And obviously, one of the main jobs of StashAway as your fund managers to help you choose the ETFs that maximizes these three factors. We dive a little bit more about how to invest the right way with ETFs in one of our intermediate seminars, so you can tune into that if you're interested. But these are overall some of the factors that we look at. And with regards to our investment framework, we essentially look at how the economy is going. So a lot of the times I get this question from clients, do you rebalance or reoptimize my portfolio when the economy changes? So let's take a step back and define what rebalancing is and what reoptimization is. So for rebalancing, it is for us to move you back to your target risk level. What does that mean? So let's say you chose a portfolio that you are comfortable with in terms of risk level. And let's say tomorrow night, markets go up 10%. Okay, and all of a sudden, you have certain portions of your portfolios that is, higher allocation now, and you are taking on more risk than you're comfortable with. So let's say, simple example, let's say that the risk level that you're comfortable with is 60% equities, 40% bonds. If tomorrow markets go up 10%, now equities is made up of 70% of your portfolio and bonds 30%. And if you go back to investing 101, equities overall tends to be a little bit more volatile than bonds. So in general, in this scenario, you're actually taking on more risk than you're comfortable with, right? So what rebalancing is, and what we do automatically for you, is that we sell some units of equities, buy some units of bonds to move you back to that 60-40 allocation that is in line with your risk appetite and the risk level that you've chosen. So that's rebalancing. The second thing is reoptimization, which is based on the factors that you see on the screen. We see where the economy is at right now. Are we in the good times? Are we in a recession? Okay. If there is a fundamental shift in economic conditions, so let's say we move from the good times where we see high growth, low inflation, to a recessionary environment where we see low growth and low inflation, then in that scenario, we will reoptimize your portfolios for you, meaning we'll change the asset mix of the portfolio to optimize for that new economic regime. Because different asset classes will outperform in different economic regimes, right? And before I expand a little bit more on that, I'm going to address also what the all-weather strategy is. And that's actually where, if you're a client of StashAway, that is the current place or regime in a way where all of our portfolios are in. And essentially, how we get into all-weather strategy is if the data indicates that you are not surely in any particular quadrant that you see on the screen. So we're not definitely in the good times, we're not definitely in a recession, we're not definitely in inflationary growth, and we're not definitely in stagflation. In an all-weather strategy, the portfolios are allocated 25% into each economic regime. And we're always monitoring the portfolios, always monitoring the markets. If there's a shift, we will re-optimize your portfolios for you. And the rebalancing and re-optimization process comes at no cost to our clients. The only fees that you pay to us is the management fee, which I'll expand on a little bit later. Okay. So moving back a little bit to why I mentioned that, different asset classes outperform in different economic regimes. As you can see, we have the average returns of the S&P 500, which is an equity index, and we also have the average returns of a US government bond index. As you can see, for both these asset classes, they perform very differently during a recession and in good times, right? So if we are in a recession, we probably want to allocate your portfolios to more protective asset classes like bonds. If we're in a good times, we probably can look towards allocating a little bit more to growth-oriented assets. So this is what we do for re-optimization. We change your portfolios accordingly for you based on data indicating where we're going. We change your portfolios for you to optimize in these different economic environments. So touching on a little bit on our different types of portfolios, the first one is our core and higher risk portfolio. So this is our kind of flagship portfolios that have been with us from the start. There are 12 globally diversified portfolios, 12 very different risk levels as well. And it is made up of US listed and US dollar denominated ETFs. And in our entire ETF universe, we currently have 33 different ETFs or different asset classes to choose from when we are constructing your portfolios. So if you're interested, you can scan the QR code on your screen. It takes you to a page where you can learn a little bit more about it. But this is the core and higher risk portfolios. And to dive a little bit, I know it's a little bit small, but I hope you are able to work out some of it. But essentially, as you can see, the portfolios, the allocations for all of these different portfolios are very different. So on average, for the higher risk portfolios, which is the portfolio all the way on the left, it tends to have a larger allocation towards more growth-oriented assets than the StashAway risk index 6.5%, which is all the way to the right. So what does all of this mean? You see on the screen SRI 36, 30%, 26%. These are the 12 different globally diversified portfolios that we have. And the numbers is essentially to tell our clients how much risk you're taking when you're investing with us. So if you look at the StashAway risk index 36%, this is our highest risk portfolio. It is equivalent in risk to 100% equity portfolio. And essentially what it means is that in a year, there is a 99% chance that this portfolio will not lose 36% or more of its value. So how are we determining this value? We use a 99% value at risk metric to tell you what your potential losses is with a 99% probability. So if you look at the 6.5% StashAway risk index, this one is equivalent to our 95% bond portfolio. So it's our lowest risk portfolio here. And essentially, what it means is that in a year, there is a 99% chance that this portfolio will not lose more than 6.5% of its value, right? So if you look at it another way for all of these portfolios, that means that in a year, there is a 1% chance that you might lose the StashAway risk index percentage or more, okay? So this is an example of the allocations. The next one is our income portfolio. It is made up of, it's a very Singapore-focused Singapore-focused portfolio made up of SGX listed and Singapore dollar denominated portfolios. It has 6 different asset classes, and essentially, if I remember correctly, it has an Asia ex Japan REITs in there. It has Singapore REITs in there. It has an investment grade corporate bond ETF. It has I can't remember the other two, but it also has the Straits Times Index ETF, which is in there to hedge your portfolio. So on the next screen, I will have the allocations of the income portfolio. But essentially right now, the projected net return is 4.4%. And out of that 4.4%, 3.75 is in the form of target dividend yield. If you want to learn more about income portfolio, you can scan the QR code on the screen as well. But this gives you an idea of the payout schedule. So we pay out the dividends whenever we receive it from the underlying ETFs. We don't smooth it out. So whenever we get it, you pay it out. So some months you might have more, some months you might have less. On the screen on the right, you can see the portfolio allocation of the ETFs, as well as the credit quality and maturity profile of the income portfolio. And at this point in time, I just wanted to quickly highlight that a lot of times people assume because the income portfolio gives you regular dividends that somehow it is low risk, and that is not true. I would say that the income portfolio is more towards the balanced risk range, and it has a statutory risk index of 12%. So what that means is that in a year, there is a 1% chance that this portfolio might lose 12% or more of its value. While we look at it the other way around, there's 99% chance that this portfolio will not lose more than 12% of its value, right? We have the next cash management portfolio, StashAway Simple. It is essentially for your short-term cash needs. It is Singapore dollars denominated and currently gives a projected return of 1.2%, which is still a lot higher than a lot of fixed deposits right now, as well as a lot of savings accounts rate. So, and this is quite a wordy slide, but I think only to just focus a little bit on the two underlying funds. It is made up of an enhanced liquidity fund as well as a money market fund, split 50-50. We do not charge, StashAway does not charge any fees for StashAway Simple. However, there is an expense ratio that the underlying fund manager charges. And a lot of times I get this question, why should I buy these two underlying funds from you instead of just buying it myself? So there are a few reasons for this. The first of which is that for us, we get we get an institutional share class. So we actually pay less expense ratio for the enhanced liquidity fund. If you buy it yourself, you are going in through the retail share class where the expense ratio is a bit higher. The second part is that if you walk into a bank and you buy one of these funds, typically 50% of the expense ratio goes to the bank as kickbacks. So the bank is basically kind of like a sales commission that the bank gets, essentially. However, for us, we get that same kickback. We get 50% as well, but we don't keep that and we pass it back on to our clients in the form of the projected returns that you see. So this is some of the difference. On average, the weighted credit rating of StashAway Simple is A, and it's essentially a very ultra low risk portfolio. And this is a quick summary of all of it. And I'm sorry, but the projected return on this screen is a little bit outdated. So it shouldn't be, for StashAway Simple, it shouldn't be 1.4%. As I mentioned in the previous slide, it should be 1.2% projected return. Sorry about that. For the rest, it is the same. So you can see the expected returns on the screen. And the mid-term capital growth and long-term capital growth, that is essentially our core and higher risk portfolios, the 12 different risk levels. And in fact, over the past 3.5 years, close to 4 years of our portfolios being live, we've actually outperformed the expected returns that you see on the screen for the core and higher risk portfolios. Okay. And moving on to fees, we charge ranging from 0.8 to 0.2% per annum. So it's kind of a stacked structure, as you can see on the screen. The more you invest, the percentage charged gets lower over time. And we charge it on a monthly basis, right? So that, if you put in today, 1 month later, you don't like us, you don't pay for the full year, you only pay for whatever month or days that you use. So whatever fees that we charge is prorated even for the number of days in a month that you were invested with us. And a lot of times, obviously, probably one thing that's most important to investors like yourself is the level of returns. So this is one thing that a lot of people often do not look at enough. People compare, wealth managers against the fees they charge. They compare a lot of different things, but at the end of the day, what should matter the most to you is the returns that your wealth manager charges. And a lot of the times, people do not look at, they essentially do not look at same risk benchmarks. So when you're comparing, for example, our StashAway Risk Index 36% portfolio, you should be comparing against 100% equity portfolio. So you should always compare against same risk benchmarks, because it's not fair to compare a low risk portfolio versus a high risk portfolio. It will have very different returns depending on how markets were. And as you can see, for us, this is as the table. The year-to-date figure is as of end January. In 2020, our lowest risk portfolio returned 3.36 per annum. Our highest risk portfolio returned 21.94% per annum. On an annualized basis, we've returned 4.35% per annum every year per annum on average since inception. And the highest risk, 18.68%. So what you should probably look at to give you an idea of how we performed over the past more than 3.5 years, you should look at the last row, which is annualized returns since inception, right? So at the end of the day, I think this should be a major consideration. And I think a lot of our clients that have compared our returns against some of the other players have feedback that our annualized returns and 2020 returns have beaten a lot of the other players in the industry. So you can have a look, and always keep in mind when you are comparing portfolios to do so against same risk benchmarks, right? And what does that mean? As you can see, this gives you a summary of what is the same risk benchmarks of all of our different portfolios. So if you look at the 36%, it's equivalent to 100% equity portfolio. For the 6.5%, 95% bond portfolio. And in terms of the benchmark indexes that we use the MSCI World Equity Index to proxy equities, and we use the FTSE World Global Bond Index to proxy bonds. And as you can see on the screen, we've pretty much beat our same risk benchmarks over time. Right, and this is since inception, so not on an annualized basis, but since inception. So finally, we are also another advantage of us, I guess, also against a lot of other players, is that we are available 7 days a week. So on the weekends, if you look at your portfolios, you want to talk about your portfolios, you want to talk about your returns, you want to talk about markets, you can give us a call, drop us a WhatsApp, send us an email, send us a Facebook message. You can reach us. We're available 7 days a week from 9 a.m. to 6 p.m. And if you call your bank, I'm pretty sure that on average, you probably have to wait 10 to 15 minutes at least to get your problem resolved. For us, you get to speak to a person on average in 8 seconds. And I do encourage you guys to try that as well if you have any questions. We have a WhatsApp button. So in the app, you can access WhatsApp, or just take our WhatsApp number from our website and just send us a message anytime. And if you send us a WhatsApp, an email on before 6 p.m., 99% of the time you will receive a same day reply. We are also the most well-rated digital wealth manager on all of the platforms that you see on the screen. So on the Apple App Store, we have, first of all, the most reviews and also the highest rating. On the Google Play Store as well as also on Sidley, the highest number of reviews and also the highest rating at 4.8 out of 5 stars. So this is obviously experiences from our users and our clients, and we are very, very honored with the kind of support that we've gotten from our clients over the past 4 years. For those of you guys that have not seen yet before, this gives you a quick example of what it looks like. On the left is the mobile app, the right is the web app. As you can see, you can monitor your portfolios on the go. On the left, it's the dark mode, which you can also set for your portfolios or change it to the light mode. And you can monitor it on the go. So you can see the value of your portfolios, the returns that you've made, what are the different asset classes in each portfolio. You can see every time we buy and sell, you can see the number of units of our ETF that we bought, the price at which we bought it, or the price at which we sell it. Everything is on the app for you. We also do a lot of education. So the first thing you see on the screen, two people. One on the left, he is our head of financial planning and workplace, Philip. And on the right, our chief investment officer, Freddie. So they do a weekly market commentary where they give you a roundup of market headlines over the past week. and any tips and answer your questions on that YouTube video as well. We also do, as I mentioned, our regular webinar sessions. You can come on board, ask any questions that you have. You can see someone from the team every single week. And then also, finally, we just recently launched a podcast where we've gotten guests from BlackRock, Crypto.com, Carta, some of the largest companies have come on board as guests on our podcast as well. So if you're interested, it's called In Your Best Interest. You can find it on Apple Podcasts or Spotify. So you can see, most recent content on the app, overview of portfolios. Also, the WhatsApp link button is just very easily available on the mobile app. Just to give you an idea of the look and feel of the app, there's a live tracker of your investments in both Singapore dollars and US dollars. You can see the overview of your holdings as well as the geographic exposure of your portfolio as well. And you can see the projections of each of your portfolio with different level of probability. So this is a quick, we've probably gone through this and I'm going to skip through it, but essentially, quick reminder again, if you're looking to start, this is the fees that we charge. But as Richard mentioned earlier, there is a special promotion for Wealth and Joy community members, viewers. So if you sign up via the link that you see on the screen, and if it's a bit difficult to copy this, you can also simply write into us via any of the channels, and we can manually apply Richard's Wealth and Joy promotion for you. You are basically entitled to 50% off management fees for the first $50,000 invested for 6 months. So that's pretty much it. And I'm going to end over here and I think, hand it over to Richard. I think we have some time for a Q&A right now.
Excellent. Thank you. That's a very, very good sharing, Amanda. It certainly gives us a very good overview of what StashAway is all about and also the fee structure. Now, just curious, just now you flashed a slide that mentioned about what's the minimum sum and whether there's any lock-in. Is there any lock-in or minimum sum?
Yeah, that's a good question. So essentially, no minimum balance. So you can start investing with 20 Singapore dollars and get a fully diversified portfolio of 7 to 11 ETFs. So it's completely up to you. So no minimum deposits. We have clients who invest $100 with us at one go. We have clients who invest millions of dollars with us at one go. So it's completely up to you. Unlimited withdrawals, no withdrawal fees, no penalties, no lockups as well. So technically, if you deposit today, 1 week later, you want to withdraw, you can do that, even though I really hope you don't do that, but you can if you want to.
Right, wonderful. I think you have covered some of the most important question, which is the safety of funds. But before we go into that, now for all the attendees out there, especially if you're watching on YouTube Live, if you have questions, please come inside the webinar rooms and type into the chat box on the screen. If you're watching this on the desktop browser, please look at the bottom right for the chat box. And if you're using a mobile browser, please scroll up or down and look for the chat box to type in your questions. Okay, I'm seeing some of you typing in the questions, so please go ahead and type in your questions now, and then we can post it to Amanda to answer for us. Okay, so while we're waiting for the questions to come in, Amanda, maybe I'll just take over the screen for a while.
Yep.
Okay. All right, so now we are entering the Q&A session, and as what Amanda has mentioned, I've also created a simple link that you can remember to enjoy the discount, 50% off the management fee of StashAway fees for your first 50,000 Singapore dollars for 6 months. And since there are no minimum, I think it's very simple to one of the best ways to know whether this food is yummy or not is to test drive it, right? Is to eat it. So you can consider to open an account. It is free, right, Amanda, to open the account?
Yes. No fee, so you put in money.
Okay, open account, no need to put in money. Okay, it's like test driving a car. Go test drive the car, kick the tire, look around, the app and the website, see, and then if you have any questions, well, take up Amanda's challenge of the asking all the communication channels and see how they perform. I think that is really a testament of their commitment to customer service. Okay, and I think that's really commendable. So if you want to open the account and qualify for the 50% off the management fee, please go to wealthenjoy.com/StashAway. All right. So on that page, you can click the link and you will see the page that you are seeing right now on the screen. Make sure you see the word Wealth and Joy there, and then click on Invest now. And then when you open the account this way, you will they will know that you are a member of the Wealth and Joy community, and they will extend the 50% to you. Now, if they didn't, I think what Amanda also said is that they can manually tag it for you. So just have to let their customer service know about the fact that you have learned about StashAway from the Wealth and Joy, and then they will help you to attach the discount. All right. So let me now go and look at the questions. Okay. So let me see. Okay. The first question comes from RW. He or she is asking whether there's a portfolio that focuses just on REITs.
Yep. So that's a good question. No, unfortunately, we don't have that. Also, simply because we don't really want to have a portfolio that is just exposed to one asset class. If you looked at in March 2020, if you had 100% REITs portfolio, you would have probably been very, very unhappy then, because REITs took a huge hit in March due to COVID, with a lot of commercial properties shutting down, lockdowns around the world. So no, we don't have 100% REITs portfolio because we don't want to be obviously overexposed to just one asset class. The closest to that is our income portfolio, which currently has about a 35% allocation to REITs.
Right. Thank you, Amanda. And Alex is asking, when the US market is in a strong bull market, the highest risk profile, 36, number 36, with StashAway will perform the best. Now, with the potential US market downturn, two questions. What profile would be more defensive? And the second question is, what steps will StashAway do to be defensive in the strategy?
Yeah. Those are really good questions. So in terms of the first question, I wouldn't say it's advisable in the sense to choose a high risk portfolio while the economy is doing well, while markets are doing well, and then changing it as we go into recession. I would say from the start, you want to make sure that you are already choosing a portfolio that is in line with your risk appetite as well as your investment timeline. So by investment timeline, meaning the longer your investment timeline, if you're saving for retirement, the more risk you can afford to take than, for example, a shorter term goal, like to buy a house in 1 or 2 years, where you probably want to allocate it to more conservative portfolios to make sure that you have your money is there at the end of 1 or 2 years. So I would say at the start, make sure you just choose the right portfolio for you. But in terms of the 36%, yes, it tends to be very, very volatile over the short term, especially when we have a market crash. It obviously will potentially have a large drawdown as well. So I wouldn't recommend it for anyone that is not comfortable with that risk index, meaning a 99% probability of the portfolio losing 36% or more. If you are uncomfortable with the thought of that, I would not recommend then choosing the 36%. Sorry, Richard, the second part of the question, if you can just remind me of that again.
Sure, no problem. Second part of the question is, what steps will StashAway do to be defensive in the strategy?
Yeah, so those are really good questions. Our algorithm essentially looks at data to determine where the economy is going. If, let's say, the data indicates that, hey, we are moving into a recession, what we'll do is that we'll move your portfolio to more protective asset classes, more defensive asset classes like bonds, in light of the fact that we're potentially moving into a recession. And so I'll give you another example. In May of 2020, last year, after the COVID crash, and at that point in time, no one kind of envisioned that crash to happen. No one envisioned at the start of the year that COVID would happen and all of the lockdowns would happen around the world. So we had that March market crash. And at that point in time, a lot of people were panicking. A lot of people were changing their portfolios, moving to some fund managers were changing the asset mix of the portfolio to move to more protective asset classes at that point in time at the market crash. But if you think about it, those the is essentially changing the portfolios after the fact, after the ETFs have already gone down. So you're essentially locking in those losses, moving to more protective asset classes. We chose to not do that, and we did not want to re-optimize their portfolios at that point in time. And in fact, markets bounced right back up in April, May, June. And then in May was when we actually re-optimized the portfolios at that point in time. So after the markets recovered a bit, then we re-optimized the portfolios, and I think it had really helped our returns as well in 2020. And in May, we did 3 changes to the portfolios because when we moved to an all-weather strategy, so we saw that there was going to be a lot of uncertainty with COVID, and there was going to be a lot of uncertainty with the US elections, if you remember last year as well. So as a result, we did 3 things. We increased exposure to gold, which is a hedge for the portfolio. It's great portfolio insurance, in our opinion. So we increased the allocation to gold. We added a new ETF called Chinese Technology, which we felt had a lot more long-term potential than US tech. And then finally, we reduced US dollar exposure, which in hindsight was a very good decision because since from May, the US dollar actually fell quite a bit against the Sing. So these are the changes that we make, determined, based on where the economy is going. Whether it's a recession or if there is more uncertainty expected, we will also make changes to your portfolios.
Right. Thank you, Amanda. Related to this question, the RW is asking whether the funds invested is using automated quantitative models, or is it discretionary based on some human making the decisions to change or rebalance?
Yep. So it is an algorithm making a decision. If you think about it, it is like a decision tree. So the investment team has, over years of experience, built an algorithm, and the algorithm looks at different types of economic data. One of our Freddie's favorite is the Conference Board Leading Economic Indicators. So they look at different economic indicators to determine where the economy is going, and based on that data, the decision tree will tell us, okay, this is how we want to reallocate the portfolios. Is there any changes required? If the algorithm recommends a reoptimization, then what happens is that the investment team will sit down, look through, and ensure that all of the inputs is correct. And ensure that that there is that decision tree making that decision, because as you know, data garbage in, garbage out. So they check the inputs, make sure it's fine, and then the investment team gives the go ahead. So it's essentially to also remove human biases that comes a lot with human investment teams making decisions. Essentially, Freddie, our chief investment officer, cannot wake up one day and unilaterally decide that he wants to add a particular asset class to the portfolio. It has to be based on data and in a very systematic way. So I hope that answered the question.
Right. So that means it's 2 parts. First part is using the algorithm. It's almost like a quantitative model of making a decision. And then the human will then verify and so-called double check whether the automated recommended decision is the way to go or to override it. Something like that?
Yeah, essentially.
Okay. Great. RRW and Alex, I hope that answers your question. Oh, I see another question for Alex. Alex, the third question is, what special steps will differentiate Stash from the competitors who also perform well during the US bull market?
Okay, so I think, essentially, I'm not sure how I can't comment on our competitors' performance. I think at the end of the day, as clients yourself, I always recommend, essentially before investing in any platform, do your due diligence, right? Be it the fees, the team behind the company, the investment framework, is it something that you resonate with? And then also, most importantly, as obviously investors, you want to look at the returns. And then when you look at the returns, make sure that you compare against same risk benchmarks. And I can't emphasize this enough. A lot of the times when I see people comparing, they compare portfolios that start at different times, and they also compare, portfolios from different risk levels. So using your example now, you kind of compare a very, low risk portfolio with a lot of allocations to bonds versus a high risk portfolio in a bull market, right? Going back to one of the slides you saw earlier, equities tends to outperform in a bull market. So obviously that portfolio is going to perform better. So what what you want to compare is you want to compare two portfolios that is equivalent to 100% equity portfolio. So that's how you would compare. And I think returns is one big differentiator. The other differentiators I would say is, looking at our license. Overall, I think it does provide a lot of assurance to our clients in terms of our internal processes and controls and how secure your funds are kept. And then next, you also want to, probably look at the user experience, which app, provides you a better experience overall in terms of the interface. And then finally, how accessible is the team, right? Do you get, obviously we emphasize a lot of education, and we're also, as I mentioned, available 7 days a week for our clients on multiple channels. And that's very, very important for us to be super accessible for all of our clients. So I think these are some of the kind of many differentiators for clients like yourself to maybe consider.
Right. Thank you, Amanda. Alex, I hope that answers your question or at least partly. And since opening an account with StashAway is free, so why not go ahead and open the account and kick the tire and ask them any questions you may have about StashAway and how they do their craft. All right. So the next question comes from Tan, and he or she asks whether does the client need to choose or select any portfolio after they open the account, or is it automatically selected, or how does that work? Or can the client have multiple portfolios? One in StashAway Simple, one in the income, one in the the core, the risky one.
Yeah, many of our clients have multiple portfolios with us actually. So first of all, if you have different portfolios with different investment timelines, different financial goals, it probably makes sense to have different portfolios as well, simply because your retirement goal and your retirement portfolio will have a very long investment timeline versus a goal where maybe you want to buy a car in 2 years. So the risk levels required for both portfolios will be very different. So a lot of our clients have different portfolios. You can either choose yourself, so either based on the risk index that you saw, you can choose which portfolio makes sense for you based on your risk appetite and your investment timeline. Or you can go with what we call a goal-based investing feature, where we help you think through which portfolio might make the most sense depending on a financial goal. So we actually recommend a portfolio for you. At the end of the day, you can also choose to transfer across portfolios, your funds, or change your risk level anytime you want as well if you want. Yeah.
Right. So if let's say they transfer the funds, is it immediate, or we have to wait for one portfolio to sell? Couple of days, and then the money goes over to the other portfolio and wait for a couple of days for the other portfolio to buy?
Yeah, so it tends to take about 2 to 3 working days. So we have to sell it first and then move to the new portfolio and then buy it again.
I see. And can a client have a multiple portfolio under the same so-called product type? Let's say StashAway Simple. Can I have like 3 portfolios there? And then maybe for the risk one, what is the name for it?
The risk index is called, so in the app, it's called general investing and goal-based investing.
Okay, so the one that has the 36%, that risk level, let's say I choose one portfolio that is 36%. Can I have another one at, let's say, 20%?
Yeah, so you can.
Okay, and can I have multiple 36% risk portfolios?
Yes, you can.
Oh, okay.
So 36%, you can have 36%, 20%, you can have an income portfolio. Only for StashAway Simple, you can only create 2 portfolios, one to be funded from your SRS and one to be funded from your personal bank account. You can't have multiple StashAway Simple portfolios.
Okay. So, and now for the next question coming from Chris, which is related to this SRS, since we're on that topic. For SRS funds, any additional TNC on it?
For us, from our side, no, in the sense that, obviously with SRS, it comes from your SRS bank account. If you withdraw, we'll have to go back to your SRS bank account, not to your personal bank account, which is the rules of SRS, not set by us. And if you invest with us, you can choose to withdraw your SRS funds anytime you want. The only kind of limitation in place is, you can't withdraw from your SRS bank account. Otherwise, the withdrawal penalties will kind of kick in. For us, there is no withdrawal fees, no withdrawal penalties, no kind of extra charges using SRS.
Right. So if I understand you correctly, Chris, I hope that answers your question. And if I may paraphrase it, Amanda, please confirm whether I'm correct or not. So to stash away, whether is it from cash or is it from SRS, you stash away will treat the funds the same, right? The only difference is that the source of fund, if it's from SRS, at the point of withdrawal, have to go back to SRS. That's the
Yeah.
only difference.
Yeah.
Okay. So in other words, once let's say SRS funds goes in, it can I can transfer it between portfolios. I can create new portfolios, and then I can move some of the SRS funds from one portfolio into the other portfolio. Correct?
You can only if it's across SRS portfolios.
Yes.
So, yeah.
Correct. Cannot mix lah. It's like saltwater fish and plain water fish cannot mix.
Yeah. Yeah.
Oil and water cannot mix. So if the okay, thanks, Chris. Yes, correct. Yeah, you got it. Yeah. So the SRS funds is treated by itself, and then cash is treated by itself, and then the SRS fund portfolios cannot move the funds into the cash and vice versa.
Mhm.
Okay, wonderful, great. Chris, I hope that answers your question. Oh, he just sent another question. He said that if he has 100K of SRS funds to invest with a time horizon of 8 to 10 years, what would be the portfolio to recommend?
Yeah.
What should
So
he do?
I can only, so based on our license, I can only advise accredited investors on specific risk levels. But what I'm going to say is things that you can keep in mind in terms of how to choose the right risk level, which is always based on your risk appetite. And you want to look at the risk index for that. And then secondly, if you have an 8 to 10 years investment timeline, that is, relatively longer investment timeline. So you can afford to take on a little bit more risk if you want to, as compared to some of your other portfolios where you have a shorter term goal. And also what I would say is that with your SRS funds, it depends on, what age you are now. But essentially, it is locked in also for, until age 65. So naturally, a lot of people investing in SRS funds tend to have a very long-term perspective with it as well. I can't recommend a particular portfolio, but what I would say is that rule of thumb, right? So if you have a longer term investment timeline, as you would here, you can afford to take on a little bit more risk than some of your other short to medium term financial goals. But with that said, you want to choose the right risk index for your risk appetite.
Right, Chris, I hope that answers your question. Maybe I can ask. Yeah, you're welcome, Chris. Yeah, so maybe I can ask it in a different way. Now, if let's say a person become a client and he has 100,000 to invest, so upon entering into the app, what should this person do? Go and DIY the portfolio themselves, or is there, just now you mentioned that there's a goal-based thing, right?
Yeah.
So if they choose the goal-based thing, then they can key in the years and answer some questionnaire, and then StashAway will recommend a certain portfolio to them via the app. Is that correct?
Yes, exactly. So that's one, or you can just choose one of the risk levels, up to you. But the other one is the goal-based investing, where we recommend a portfolio based on all of the inputs that you have.
And likewise, this person can slice the 100K of the SRS funds into, let's say, 30,000, 40,000, 30,000, three parcels, and then deploy them differently by choosing the different goal differently, correct?
Yep, exactly.
Okay. Chris, I hope that gives you some ideas on what you can do, since Amanda cannot advise you publicly. All right. So, okay, let me move on with the question. Okay, RW is asking, how long does it take to withdraw funds back to the source? Let's say cash or SRS.
Yep. So for the general investing in the goal-based investing portfolios and the income portfolio, it takes about 2 to 4 working days, I would say. And then for the StashAway Simple, it is 1 to 3 working days. So we just lowered it. It used to be about 2 to 3 working days. We've actually managed to work with the underlying fund manager for StashAway Simple to make it faster. So now it's approximately between 1 and 3 working days.
Right. Okay. RW, I hope that answers your question. Okay. Related to the question on the goals or whether you pick the risk level and just DIY yourself, or you use the goal-based way to get the advisory or the suggested portfolio from the app. Is there a way that we can speak to somebody to talk to us about it instead of just interfacing with the app?
Yeah, you can reach out to our client engagement team, and we can either walk you through it or also connect you with the right person. So feel free to just reach out to us through any of those channels, and we can help guide you through any point of the app. You don't always have to interface with the app. If you are not sure about anything, feel free to just drop us a WhatsApp, give us a call. We're happy to help.
Right. Okay, that's good. I guess that kind of answers some questions, because some may not be very familiar with the different terminology, or they have questions about how StashAway can help them to achieve their financial goals, so they can at least speak to a human.
Yes.
Yeah. Okay, that's wonderful. Okay, let me move on. Let's see. Okay, Daryl is asking, how often does StashAway review or adjust the risk percentage, the allocation?
If you mean the risk index, we try not to change what's available, the risk index that you see. If you mean the actual underlying allocations of each of the ETFs, we've only done 3 reoptimizations since we launched in July 2017. The first one was in December, when we increased the allocation to gold. At that point in time, gold was trading about $1,200. If you look at gold right now, in hindsight, that was a very good decision. The second one was in August of 2019. And then for that one, we actually moved to an all-weather strategy for non-US economy, which at that point in time, the data indicated it was slowing down, while for the US, it was still showing strong growth. So that was a change that we made in August 2019. And then the most recent one was in May 2020, when we went through the 3 changes I mentioned: increased exposure to gold, added Chinese technology ETF, and then reduced US dollar exposure. So it's only happened 3 times. We're always monitoring the economy, always monitoring markets and leading economic indicators to see if any changes is necessary. If changes are necessary, we will automatically do that for you. So as the analogy that Richard mentioned from the start, it's, if you want to just sit back and relax, essentially this is what we do. We manage the entire thing for you. We are your fund managers.
Right. Wonderful. First class service. Okay, Daryl, I hope that answers your question. And Daryl's follow-up question is basically whether can he just deposit and don't think about it? I think the answer to that question is yes, correct?
Yes.
Yeah,
yes.
Okay. Okay, let me see. Okay, Danny is asking, what are the 6 different asset classes in the income portfolio? And is 4.4% a conservative return?
The 4.4% is based on historical returns of the 6 different asset classes in that portfolio. And yeah, I mean, to be honest, last year, the income portfolio did struggle a little bit, simply because it has quite a large allocation to REITs that did, as I mentioned, suffer a little bit because of the March market crash and all of the lockdowns. So, but as of now, we are still maintaining that 4.4% target net return projected. And then out of that 4.4%, 3.75 is still the projected dividend yield. In terms of what are the 6 different asset classes, we have, as I mentioned earlier, we have Singapore government bond ETF. We have, and I believe, an Asian high yield in bond in ETF as well. We have an investment grade corporate bond ETF. We have 2 real estate ETFs. One is the Asia ex Japan ETF. Asian ex Japan REITs ETF, as well as the Singapore REITs ETF.
Right. Okay, Danny, I hope that answers your question. Thank you, Amanda. Okay, so if you have any more questions, please keep them coming in. Otherwise, I'll just be moving on to the next question. The next question comes from Henry. Given the funds are invested in ETF, are the values based on the end of business day closing price, or is it as and when the instruments are being sold or bought during the day?
That's a really good question. So in terms of what you see in the app, it's always based on the previous day market closing price. So I mean, that would be updated usually by, I would say, 2 p.m. on any given day. You should see your app updated to the most recent value of the previous market day's closing price. So I hope that answers your question.
Right. So that means that in terms of the portfolio NAV, it is updated once a day.
Yeah. Yes, it is updated once a day based on the previous day's market closing price.
Right. Understand. Okay. Now, Daryl is asked this question. He asked, any rescue level to avoid losing everything, including capital? Wow. I don't know what is rescue level. Amanda, you know?
I think maybe like a stop loss. So no, we don't have a stop loss in place. And, which is why also at the end of the day, we do recommend that, you always choose a risk level that's in line with your risk appetite. And a lot of the times I have many clients who, are looking at returns only that the higher risk portfolios provide, not looking at the risk level. And then when markets are volatile, they are kept up at night. And then when markets go down 10 or 20%, they panic and then they sell at the worst possible time, which is when prices are low. So choosing the right risk level prevents all of that stress, or you having to deal with all of that stress. But short answer to your question, unfortunately, we don't have any rescue level, or if you mean a stop loss, we don't have like a stop loss in place.
Right. So if maybe I'll just piggyback on his question. Let's say if I choose a level of 36, what does it mean? Does it mean that if, let's say, in event that the drawdown is 36%, then something will happen, or as it approaches that level, then something will happen?
Yeah. So essentially, our goal is to stress test the portfolios across all scenarios. So we did that against the global financial crisis, across the crises, the dot-com bubble, the Asian financial crisis. We stress test across all of these market crashes to make sure that when we determine the 36% with 99% probability, that is really a stress testing event. So I'll give you an example. None of the portfolios, so the StashAway risk index means that, for example, the 36%, there is a 99% chance you will not lose 36% or more of your portfolio's value in a year, in a year from at a certain point in time, right? And in that scenario, none of our portfolios have ever breached that risk index level based on that definition that we use.
Right. And how did that portfolio at the 36% level perform during the COVID crash?
That is a good question. Let me just actually pull it up right now so that I make sure that I give you guys the exact numbers.
Sure.
So the 36% in Q1 of 2020, so in March, was when the market crash happened, right? So in Q1, it returned negative 14.94%. But in Q2, the portfolio went up 23.63%.
Right. So quarter to quarter, there was a drop of 14% when the market dropped by about 30%, correct?
Yeah, I mean, peak to bottom, I think it was more. But if you look at the whole quarter, it was about close to negative 15%. And then markets went up. So that portfolio returned in Q2 23.63%. But for the whole year, 2020, the 36% StashAway risk index portfolio returned 21.94%.
So someone who put in from January the 1st until the end of the year, they are, despite the drop, they are still up by that 20%.
Yes.
Wow, that's quite a recovery. So if whoever that invested started the investment during the bottom, then would have gained a lot more, isn't it?
Yeah, I mean, theoretically, but also very difficult to tell the bottom. And then going back to what I mentioned earlier, a lot of fund managers actually at that point in time in March moved to protective asset classes. I think there are a few other players that did, re-optimize their portfolios in March. They actually missed out on the rally right after the crash.
Right. Okay, so during the crash, did StashAway do anything, or the design of the algorithms stay put and was able to, still beat the market with
So
a
we didn't
minus 15 instead of minus 20, 30%.
So we didn't make any changes to the portfolios. To be honest, that crash was not something that I think any fund manager really expected. So even for us, that was not something that our portfolios expected or we expected. But we didn't want to make a change after the fact, right? Meaning after the markets have crashed, after the portfolios are down, and then lock in those losses and move to protective asset classes, as did many fund managers. So we didn't want to make a change then. And we actually stayed on because if you look at the data for fundamentally, the economy was still relatively okay. But then after that, markets actually did improve. And then May, that was when we actually re-optimized the portfolios.
Okay. Okay, got it. Let me see. The next question comes from Tan. Tan is asking, any expected return percent in a 5-year timeline?
Expected returns 5-year timeline for which portfolio? Okay, so I'll give you an example. So there's no 5-year timeline, but just expected returns for the general investing portfolios. For example, the lowest risk, the expected return is about 2.9% per annum. And the highest risk portfolio, I believe the expected return is about 12.8% per annum. But in fact, if you actually look at our returns on an annualized basis over the past more than 3.5 years, we've actually beaten our expected returns as well. But that gives you an indication. But it's not just confined to a 5-year period. Obviously, as I mentioned, the high risk portfolios, we recommend a longer investment timeline, at least 5 to 7 years, when you're looking at investing in those.
Right. Okay. Tan, I hope that answers your question. Now, the next question comes from ST. ST is asking whether the hit on the return in March last year, was it due to a large amount of people withdrawing from the fund, from StashAway, or is it due to the market prices of the underlying ETF that causes the drop?
Yeah, so it has nothing. The returns have nothing to do with our clients withdrawing. So it's not an indication of any outflows or inflows that happened. It is basically how markets performed, how our portfolios performed in the markets. And in fact, actually in the March 2020 market crash, we saw actually a lot of our high net worth clients actually putting in more. And the majority of our clients actually stuck to their investment plan. So, continuing to dollar cost average into the markets. And I think, this was also a lot of years of us educating and telling them the importance of sticking to their investment plan. So those people that, didn't really panic actually, was on for the ride for the rally that happened after the March market crash.
Right. That's good. Right. Okay. Let me see. Now, on the topic that you brought up an interesting term, dollar cost averaging. So does StashAway have a feature in the app or in your website that can facilitate that?
Yeah. So, traditionally, if you want to do dollar cost averaging, you typically have to set up a standing instruction with your bank, set up in your internet banking, set up every month, dollar cost average into your portfolios. But when we launched StashAway Simple, we actually got a lot of feedback. Once again, client feedback, which we, as I mentioned, always take note of and try and act upon, that they wanted to dollar cost average from StashAway Simple. Because StashAway Simple was giving 1.2% projected return. When we first launched, it was actually 1.9% projected return, which was much higher than a lot of fixed deposits and savings accounts. So our clients actually wanted to park their money there instead of parking their money in their own bank account and then dollar cost averaging from there. So you can actually automate your dollar cost averaging from StashAway Simple into your investment portfolios.
So that means you park the lump sum into StashAway Simple, and then from there set up automatic instruction, is it?
Yeah.
And then point it to a particular portfolio and say, okay, every month deduct X dollars from my StashAway Simple and put it into portfolio A, and then every month deduct Y dollars and park it into portfolio B.
Exactly.
Okay. And that transfer of funds from StashAway Simple to the portfolio, is it also take about 2 to 3 working days because you need to sell something and then buy something on the other side?
Yeah, I think it would take about 3 to 5 working days, a little bit longer, because StashAway Simple takes a little bit longer to liquidate. So about 4 to 5 working days. But if you're dollar cost averaging, obviously, you're also not trying to time the market. So I think that timeline does not really matter to a lot of our clients.
Okay. For the DCA, can I set a calendar, or is it always on the first of the month? Can I say every 2 months or every 3 months, the 15th of the month, that kind of thing?
Yeah, so you can choose the exact date you want. Whichever date is your lucky number, you can choose it.
I see. So it's always on a monthly basis, or it can also be at a different interval.
You can do bi-weekly or monthly.
Okay. Bi-weekly or monthly. Okay, got it. And can be done to multiple portfolios. Huh? Very good. Very nice. So let me give another scenario. So let's say if a person believes in DCA, right, instead of lump sum.
Yeah.
So let's say, for example, Chris just now, he said, I have 100,000. So let me park it into StashAway Simple under SRS. And then I'll create a set of portfolios with different risk levels or different products that StashAway have.
Yep.
And then I set up monthly DCAs from my StashAway Simple SRS funds into the myriad of portfolios also using SRS funds. So that can be done.
Yes.
So therefore, you spread out in time, you diversify not just in the portfolio, but you diversify out in time, so that you won't be buying at a high, for example, right?
Yep.
Okay. Idea for you. Okay, wonderful. Okay, the next question comes from RW. Wow, these are the frequent asking one. So RW is asking, in case of paper loss, do we need to top up funds?
No, so you're not investing a margin. So this is not a leverage investment. It is, if you want to, you can. For us, it's whenever you want to deposit, whenever you want to withdraw. It's fully flexible, up to you. In case of paper losses, meaning you haven't actually sold it, it's not realized. No, you don't. It's not like we're gonna do a margin call and you have to top it up. Unlike a lot of other structured products out there, which actually during the March market crash, some of our clients that buy structured notes from the private banks, because of the crash, they got margin calls and actually had to obviously try and find money to meet those margin calls. So I think this is what RW is asking about. In our case, no, you don't have margin calls on us for us, and you can choose to top up if you want to. If you don't want to, that's fine too.
Right. And for related to the question of the DCA, the standing instruction can be created anytime and also cancelled anytime. Is that correct?
Yes, that's right.
Right. Okay. Okay, great. So the next question comes from RW again. What kind of portfolio would you recommend for retirees?
For retirees, okay, so I think this is a good question because a lot of times people retire, like let's say you get to age 65 and then the first thing that they have is transfer everything into their savings account. Like they take on no risk at all. So I think one thing to keep in mind also is that when you're age 65, you still have probably 10, 20, 30 years to live. On average in Singapore, the average age I believe that men live up to is 83, for women 85 years old. So on average you can live close to 20 years more, which is still a relatively long investment timeline. So you probably want a good mix of capital preservation, right? To make sure that obviously you preserve a certain level of capital. You also want to have a level of regular income. So which is why typically our income portfolios for people in retirement, they want that regular income flow to pay bills, meet expenses, stuff like that. And then finally, you also want a certain portion maybe of capital growth as well, because you still have a 20 years timeline as well. I wouldn't say put all of your portfolio into a capital growth portfolio, but a certain level of that into a portfolio like that would make sense because you still have typically quite some time to go.
Okay, great. RW, I hope that answers the question. And with that, that's all the questions we have at the moment. So if you have questions, please feel free to reach out to StashAway and ask them anytime. They are available 7 days a week. And also that the special offer for the Wealth and Joy community is on 50% discount for 6 months on your first 50,000 Sing dollars under management. And opening account is free, so go ahead and open the account with them. Kick the tire, check out the app, and then maybe create some portfolios. And since there's no minimum, well, you can put in a little bit just to test water. So on the question of the discount, Amanda, if let's say a person have, let's say I started out just wanting to test water, I put in $100, and then I create 4-5 account, each one I put in $100, and then once I got comfortable, I put in, let's say, the 10,000 or another 50,000 from SRS, and then 50,000 cash. So all the management fee will be discounted for 6 months, is it?
Yeah, 50% for 6 months, yes.
Okay. So I think my plan is very clear. is to get started, put in an amount that you're comfortable with to get familiar. Ask the questions that all the questions that you want, the additional questions that you have as you explore the platform. And then once you're comfortable, then feel free to put in more if you so choose to. All right. Again, I'm also not financial advisor. You do your own due diligence, and then you do things at your own risk, right? Because profit you keep, losses also you keep. So yep. So with that, Amanda, thank you very much for your time today to share with our community about StashAway, and also taking the questions from some of our members here. So any last words with our attendees?
No, I know I had a great time, and I think your attendees had really, really great questions. So thank you so much for having us on. As I mentioned earlier, if you think of any questions after tonight, just feel free to reach out to us anytime. We're happy to guide you through any part of it. And if you just want to try it out, get started, you can use Wealth and Joy's promotion to test it out.
Yes,
thank you so much,
Amanda. Thanks, Amanda. And for all the attendees, again, to gain access to the special discount, just go to wealthandjoy.com/StashAway, and then you can see the link there that you can click to enjoy the special promotion. And until the next time that we meet, thank you very much. Stay safe and enjoy your coming weekend. And thanks, Amanda, once again.
Thank you, Richard. Thank you, everyone. Have a good evening.
Thanks. Bye-bye.